In your multiple decades of investing, and in particular around AM in the UK, have you seen it to this level in previous years?
I've
Have you?
I've never seen it to this level. I mean,
Right.
we've been obliged to trade out of so many AIM stocks over the last 12 months, and I've never seen last week, I think every day there was a deal mentioned, although the week before it was Monday, it was XP Power, Tuesday it was Keyword, Wednesday it was IQ020. Every day was bringing some kind of deal. And this is at the small end. This is not the big press end. This is not the stuff that's capturing the headlines. A bit
Yeah.
like BHP for Anglo, or the guy trying to buy Royal Mail. He owns,
Yeah.
the majority holder trying to buy out Royal Mail. These are small 200, 300, maybe £1 billion companies.
Hello and welcome to the Investors Champion podcast. The goal of this podcast is to give you a quick but informative rundown of some interesting topics affecting UK investors and a rundown of the biggest movers in the UK share market, including AIM, and some bonkers bargains for you to take a closer look at. Let's get started. Hello, Chris. Good to see you again.
Hello, Lee. Good to be here, as always.
Yeah, well, in the last episode, we touched on takeovers. It's almost daily, certainly weekly, where there's a new takeover or an offer for a takeover. We thought we'd actually go with an episode that's purely focused on takeovers.
Yeah, look, it's a topic that's coming up all the time, as you say. Every time we have a chat, we have this takeover of that or an offer coming in. As I've said before, a takeover mania is gripping the UK stock market. And why? The first question is why. The obvious one is companies are cheap. People have been saying this about the UK listed shares for a long time, and they're clearly great value. And we saw the last time this was brought up, I read an article only a month or two ago, the takeover offers had amounted to 78 billion. And it's the highest since 2018. Since then, however, that's not the end of it. Since then, I count at least two more that have taken it over 80 billion plus. We've had the likes of Dark Trace, the cybersecurity company on the main UK market, that's gone. DS Smith, the paper company, has been taken over. So yeah, shares are cheap. UK is cheap, and the takeover mania illustrates that really, which is frustrating.
Is it as simple as the UK market is cheap right now?
I think it is to a large extent. I think it is as simple as that the UK market's cheap. The other factor, the key factor, people have seen that a lot of these takeovers are being driven and orchestrated by private equity or private equity backed vehicles. And private equity has got a lot of cash and it's struggling to deploy it. And it sees a cheap venue as the UK to acquire companies. I think the other issue is UK institutions have been very happy to accept these offers. That's the most frustrating thing for us. Why are UK institutions so happy to sell out in businesses, some of which they haven't even held for very long? Dark Trace hasn't been on the market for that long, and the institution's happy to sell out for prices that don't look massively attractive often, which is a problem. My other worry, my other thought behind UK institutions' willingness to sell is that a lot of these institutions, being fund managers, collective investment schemes, unit trusts, whatever you want to call them, have been suffering from their own redemptions. There's been a bad time for markets, UK market. So a lot of investors have been pulling money out of funds. If you've suddenly got one of your companies being taken over and it dumps a load of cash back in, well, it's easy to accept the deal to fund all your redemptions, which is frustrating.
Do bonuses factor into it as well? When suddenly they're able to realise the profits, the rewards of
Yeah, it's a good
said
point.
company? I'm just
Re-
thinking, I don't know, you
yeah,
know more on
really
that
good.
side of it than
No,
I.
really good point. So a lot of senior management's rewards, remuneration is based share based, and they can be a big payout to them. Their options are all crystallized, they're triggered. Happy days that they're suddenly in the money. They're often very keen to orchestrate a good deal, especially if they think it's looking a bit rocky. Look, let's get out now, cash in, and off we go. Wait a few years, we can step back into the market, fill our coffers. But it's not great for shareholders, because the really frustrating thing is companies, many of these deals are happening to companies that have been going through tough times. They're recovering, and the deals are quite a nice premium to the share price at the time, but not necessarily a great premium to where the shares were maybe a year and a half ago. And especially a company that's recovering and restructuring could go on to deliver multiples more than what the premium is, the takeover premium, albeit that shareholders are going to have to wait a little bit longer to get the full benefit. There's a massive lack of patience, isn't there, at the moment?
Is this a global trend that we're seeing, or is it particularly quite focused here in the UK at this moment in time?
I think there are a lot of deals going on, but it seems to me that the UK market, in relative terms, relative to its size, number of companies, is probably seeing more of it
More than others, yeah.
more than others.
Yeah, and that's a touchy subject to bring the word Brexit up, but I think we have mentioned this in the podcast in the past. How much do you think Brexit is playing into this?
I think it's a big factor in the cheapness of UK stocks and the lack of appeal of the UK market. I think Brexit has a big part to play in it. Yeah, you can't ignore it. It hasn't been great news for a lot of businesses, those trading internationally, having to resort out all their border transactions. Hasn't been easy at all. You make a really valid point on that.
Also, the perception of the UK. Do you think the political environment that we've just witnessed for the last, 4, 5 years has played a part in it as well? How many prime ministers have we had? 3, 4?
Yeah, look, stock markets hate uncertainty, right?
Uncertainty,
And
isn't it? Yeah.
political uncertainty's been diabolical. We've got an election coming up now, depresses everything. Uncertainty. If you're invested, oh, crikey, do I want to be part of this sort of environment? There's so much uncertainty. I don't know if I stick money into a house builder, what the next government, how it's going to alter the house building sector at all, or do I? It's that uncertainty. I'm not saying over the long term, as we've expressed before. I don't think elections affect markets. But there's this short-term sort of issues that impact investor sentiment.
Yeah. I suppose on the flip side as well, we're talking about this as a bit of a negative, but I suppose if you flip it around to a positive, that obviously there's value in the UK, isn't there? There's obviously companies that private equity that is awash with money is looking at thinking there's some good deals there.
Yeah, they are. Yeah.
So in the flip side, that's actually a positive, isn't it, for the UK economy, the UK market, that these professional investors see value.
They do, and I think that the UK investor base is only now starting to wake up to it. We've been banging that drum for months, last year, in fact, specifically for many of our AIM stocks. We're saying, look, these stocks are cheap. And if you want any proof that they're cheap, look, CVC are just buying this, our AIM company. KKR are buying this one. Oh, KKR, these are all big private equity brokers are going to buy another AIM company. But we've been banging on all the time that these companies are cheap. And investors, unfortunately, have seen limited return in the short term. But if private equity sees they're cheap, wow, the UK investor base should see there's great value well and start backing the truck up and really buying into it. Buying in. There are some great value opportunities out there. Want to go for it now? You never will.
Yeah. And if people are wondering, okay, then Chris, where's the great value? Check out the bonkers bargains and stonking small caps at Investors Champion.
Yeah, spot on. They're all there.
They're all there. They are all there.
And all that. I mean, we honestly, lately, too many bargains for us to even categorize as bonkers bargains. You look at I think the construction services sector, the construction sector itself. I mean, there are so many businesses that are going to come out smelling of roses. It may not be instant, but they look so cheap. They've just got to batten down the hatches for a while, make sure they're managing things efficiently. When the cycle changes, we're going to be off to the races there.
Yeah, XP Power was a bonkers bargain, wasn't it? And that's
XP Power, yeah.
That's had an offer.
And that's the example of a cheeky, opportunistic offer. They've seen a UK listed stock really down and out, struggling. It's got a recovery plan in place, and they will have a go for this now. And they put in several cheeky offers, and the board says it's not even acknowledging them almost. That's the nature of offers. You have the cheeky offer that nobody wants, a sort of casual approach. Then you have a firm offer that materializes that the board actually approves of. And we have one of those with Keyword Studios. I think a private equity fund has come in and had a look at it, shoved out two or three cheeky offers, and finally it's come up with something that looks, to the board's opinion, reasonably credible. And they said, well, we're happy to entertain this one. So you've got to identify what's credible and what isn't, and the nature of offers. There are occasionally really good deals. I'm not totally against takeovers, and I think one takeover that should be mentioned as I think a really good deal was the takeover of Hotel Chocolat by Mars, the confectionery group. Hotel Chocolat, a nice business, quite strong in the UK, but was really messing it up overseas. It messed up in Japan. It was struggling in the US. It tried to sort of dip into Scandinavia, and it kept on messing things up. But it had this really strong brand, and Mars came along, isn't a listed business, and effectively bought it for what was about a 170% premium to the share price before. It wasn't going to mess around with counter offers. It came in with a very high offer to say, look, we know you're struggling almost. Yeah. You're worth more than currently. It's going to take a long time for this to work out, but we're willing to be patient. So I think that was a good deal, and management clearly were in need of help to develop their international aspirations, or to support their international aspirations. So I think that was a good, my opinion, a good takeover.
And also as well, they're probably still in charge of the company. They're still running the day-to-day operations. Would you agree with that?
Yeah, often. Yeah, I agree. Often they've orchestrated the deal as well. Some of them, I think, roll their stakes as well into a private equity fund that's financing it. You're right, but
Yeah.
they're often staying around.
Wasn't Smart Metering Systems, was that a company that Fundamental was once invested in as well?
Yeah, we held that in our AIM portfolio. That was a shame. Smart metering system, the name suggests, provider of smart meters in the UK. Clearly, it's a big market and other carbon reduction sort of assets. And that got taken over for 1 billion by private equity. It was, I think, the single biggest dividend paying AIM stock. So you can
Right.
imagine we like to have some dividend income coming through. It's not a be all and end all because we're growth investors. But yeah, that's a shame. That business has now been snapped up, which was a great pity because I felt it had a lot of funding in place. It had a seemingly supportive investor base. So that was one that we didn't necessarily welcome, and an impossible business to replace as well. There isn't another one. If you are AIM focused only and doing it for IHT planning purposes, you can't find another business like that on AIM.
And correct me if I'm wrong here, but the ultimate objective of private equity is to take the company off the stock exchange and then bring it back to the market and then sell it at a premium back to the very investors that have had either sold out now today and then buy it at a
Yeah,
premium
if you hit the nail
multiple
on the
years
head.
later.
You've hit the nail on the head. That's exactly it. So shareholders will sell out now. Private equity probably will do. Money isn't cheap anymore. So
Mm.
there's no quick win on leveraging up with cheap debt. That's gone. They'll so-called improve it. I think research has suggested that's not often the case with private. There's little real improvement goes on. It's just a timing issue. And then at 3 to 5 years down the line, hey presto, we'll see smart metering systems reappear as super smart metering company PLC back on the stock market, or it's bought something else. Super smart metering giant is now
Yeah.
appearing on the stock market at maybe twice, 3 times the price than the smart metering was acquired.
Perhaps maybe a bit of a generalist answer here, but it's, as you say, it's more timing than anything. All they've done is waited for the cycle to turn, and they've come back when the market is kind of in that rising phase, doesn't
Yeah.
it? Yeah.
They can strip out a few costs. They can strip out PLC costs. You haven't got stock exchange costs. The board can be a lot leaner. So profitability is flatters in the interim, and they'll come back on the market again at the most opportune time you can imagine, at the top of the cycle
Yeah.
at a massive great price. Or in between time, what has been happening is one private equity selling to another. So there have been some private equity deals between themselves because private equity's got so much money. But yeah, that's often that happens.
In your multiple decades of investing, and in particular around AIM in the UK, have you seen it to this level in previous years? Have you?
I've never seen it to this level.
Right.
We've been obliged to trade out of so many AIM stocks over the last 12 months. And I've never seen it. Last week, I think every day there was a deal mentioned, although the week before it was Monday, it was XP Power, Tuesday it was Keywords, Wednesday it was IQ020. Every day was bringing some kind of deal. And this is at the small end. This is not the big press end. This is not the stuff that's capturing the headlines. A bit
Yeah.
like BHP for Anglo, or the guy trying to buy Royal Mail. He owns,
Yeah.
the majority holder trying to buy out Royal Mail. These are small 200, 300, maybe £1 billion companies, not the 35, whatever that is, the Anglo-American deal.
Hargreaves Lansdown was a surprise as well. Fancy someone trying to take, on a private equity, trying to take Hargreaves Lansdown over. I mean, just wouldn't have expected that.
I know that again, that's, I would say, the casual approach.
Yeah.
Again, it has been struggling a bit, overpaid, was putting money into areas that didn't really deliver, seems to be more better focus. So this is a huge business, massive DIY investing platform. Apparently, you've got about 40% market share, 150 billion of assets under administration in its stewardship. So this is a big play. And I think, again, UK financial services as a whole, which is ripe for takeovers. We've had Mattioli Woods as well in that space. We've had some others. I think Charles Stanley got acquired as well. Bruin Dolphins got acquired previously. And there are loads of them. And even off market, private equity is incredibly active, an active acquirer and supporter of in the financial services sector. There are lots of private equity funded vehicles acquiring lots of independent financial advisors and bolting them all together. So it's been incredibly active, and a lot of UK investment managers look really great value. And again, as markets improve, you'll see magically their returns improve as well.
Do you think the London Stock Exchange focus has shifted away from what started out as the London Stock Exchange, and we've seen that significant growth over a couple of decades, to much more focused on the data side of things? Maybe more trying to compete with, say, Bloomberg as opposed to other exchanges.
Yeah, I think you're right. It's called the London Stock Exchange Group, but is its main business now data or is it a stock exchange? I think what you're suggesting is correct, that it doesn't make that much money out of being a stock exchange. So why is it going to be interested in it? It makes its money out of data, and that's where it's put all its emphasis and its resources, where it sees the future. So yeah, are there grounds for ditching the stock exchange bit and sticking it in another separate entity, or maybe merging it with other stock exchanges that are more worried about bringing companies to market, supporting those companies on the market, rather than worrying about all the data that they're churning out?
I've got a quote here from him, David Schwimmer, the chief executive for the London Stock Exchange Group, that he sees the future in data rather than trading exchanges.
Yeah,
So
well,
if you,
bingo.
yeah,
Yeah,
so that is it in a nutshell there, isn't it?
yeah,
That one sentence, it shines a light, doesn't it, on their focus on the London Stock Exchange. Are they
yeah,
really that
yeah.
bothered how many companies come and go? That's a good question to ask, isn't it, actually?
Yeah, it is. And I think if you look at we've said before, you look at their website, does it reflect business that's very too bothered about its listed companies? Is it doing much to spread the word and promote and encourage interest in the listed company? I don't think it is really. They're bending over backwards now, apparently, to try and welcome Shein listing. Well, is that also the type of business that we really want? If you're really, proud of your exchange and want to accept it, welcome the right kind of businesses, is that going to be one? That's another matter.
Yeah, with all the global tensions in the world, one would perhaps be wary of it, wouldn't they? But
Yeah.
I'm just thinking as well about the share voting, the difference between the share voting options that they have in the US compared to here in the UK. In the UK listings companies from issuing classes of shares that carry different voting rights. Whereas in the US, founders can use different shares to retain governing control over the company. So they can issue non-voting shares. Whereas in the UK, the regulatory framework doesn't allow for that. So you can see why founders would be more inclined to list in the US because they get to keep control of the company. I mean,
Yeah, no, this is a point. Yeah.
that's going to be a massive reason
Yeah,
why companies choose the US over the UK.
I think you're right. If you're a founder who's looking to list and of a sizable business that will work in the US on the US market, you're more likely to go to the US if your voting position and your control over the business can be retained. I mean, that is an issue for founders. Why don't I? Or the alternative, if they stay on the UK market, they can't release so much equity and they're still stuck holding the majority stake, which may not be comfortable for them.
Yeah, I guess as well, the company that you would probably want to drive that, or the individuals, the people that you would want to drive that regulatory change, or maybe shine a light on it as a bit of an issue to encourage companies to list, the London Stock Exchange, they're more focused
On the data bit.
on the data bit. Yeah,
Yeah. But it all still falls down to one decider, who the shareholder decides what goes on.
true.
And
Very true.
and
Yeah.
just like anything, we're down to psychology here. Shareholders suddenly, for argument's sake, Keyword Studios, let's give an example,
Yeah.
presented with a 70% shareholder a premium to the price before. Clearly, if you're an institutional share, you'll think, wow, that's going to really improve my quarterly fact sheet, my quarterly returns. That's really going to boost my numbers if I'm a meaningful shareholder in that company. If I agree to a deal now, it's going to give me some short-term wins. Given that they've been bleeding over the last few years, you can sympathize that maybe they want to take the short-term wins. However, psychologically, is it time to say, if I hold my ground here, don't take this, let's stick around with this business, funds are going to start flowing back to me, this company needs support, I'll be there to help it. Maybe I can do better over the longer term. So it's either taking a short-term win, boosting my short-term return, waiting patiently to see this out. Yeah, and sometimes it's deals, right? If it's a hotel chocolat deal, fine. Or if we had one on AIM, Property Franchise Group merged with another company called Belvoir Viva on AIM. They were both similar businesses. The merger, they're crying out to them to come together for years. Suddenly, you've got two subscale businesses that are now businesses of quite decent scale. And that, to me, made sense.
Yeah.
But so many of these others that are cheapskate offers during times of duress for a business just don't They really don't make much, especially with the companies involved who haven't even come through their recovery and they've got decent products, services that conceivably probably more inclined to do better than worse. Stick with it, I would.
What's the solution then? If we were to leave it on a good note now, what can we all do to try and help?
I think investing is all about psychology, and you've got to hold your ground sometimes to get the better deals, whether you were an early investor in Apple, Microsoft, Monster Beverage, Abcam on the UK, any business. You've sometimes got to, when things look tough, but you still see there is a great long-term outlook there, you've got to hold your ground. So shareholders, if they believe in their businesses, they should stand firm and see things out and support them, keep them going.
That sounds good. Sounds
So
good.
I think that, look, there are some great businesses in the UK. They just need a little bit of support, a bit of love.
Yeah, and as we said earlier, visit Investors Champion to learn more about those businesses. Bit of a change from our usual sort of rundown of the news, but just thought we'd see what the audience thinks of this type of topical content. Thanks, Grace. Thanks for the time.
Thanks very much.
Thanks, mate.
You as well. Bye.
Bye. Well, that's it for today. Please subscribe for next week's episode as we will once again discuss global events, the UK share market, and some more bonkers bargains for you to take a closer look at. If you want to take a deeper dive into any of these topics and indeed more exciting and interesting companies, then please feel free to visit investorschampion.com to learn more. All the links are just in the show notes just below. Many thanks for listening, and we hope you have a great day.